program from the UK, especially for gaming. Yeah.
I'm in Troy. I'm also with the gaming board. Why are you taking this? Justified or we get experience to pay for it, refresher.
Okay. You did accounting before?
Mm-hmm.
Okay. And what do you do at the gaming board?
I work in gaming, accounting, and financial services.
Okay, but that means you keep the books of the gaming board, or you go out into the game and you are like an inspector, or what?
My area is responsible for regulating all casino revenue, all gaming revenue in the dialogue.
Ah, okay. So you don't go into the casinos, you just count the money?
No, we count the money. We go in the casinos, we go in the web shop, we verify all revenue, we reconcile to ensure that accuracy of taxation.
How do you reconcile? How do you verify?
Process. We audit.
You audit their
The
books?
actual versus their.
So they have their own auditors, and then y'all go in and audit their books again?
Yes.
So how long do you spend in a casino on Paradise Island when you're doing an audit?
We audit daily, every day.
No, but I'm saying you're over there every day
Every day. Physical presence.
Physical presence
Every day, 24 hours.
and go through their books. I'm asking all of this because I don't know if you know a country called Suriname, which is in South America. I used to do work for the central bank down there, and they have slot machines in restaurants and bars and stuff like that. And they have casinos as well. But the way they verify their revenue is they go in and count the machines. And I said, well, how does counting the machines tell you to win? You know what I mean? But they haven't reached to, I guess, the level of yours, where they're actually checking the books. They say, well, if there are 50 machines, the average win is this, and they do an approximation.
No, we go into the system and check the reading on the meters.
Oh, okay, okay. So any special training for that? How long does it take to learn how to do that? You don't have to be a CPA or anything like that.
No.
All right. Who's the other one? Oh, right, go ahead.
My name is Anissa Lopez. I work at Deloitte and Touche.
You're an accountant?
I am, but I'm under audit, records and retention.
Okay. Ma'am, you're new?
Yes, I'm new.
Okay. You signed the attendance?
Yes, ma'am.
Okay.
Yes, sir.
Okay, tell us who you are and why you decided to come visit with us.
Okay, my name is Tanya Seymour, and I work at NIB in accounts, but I'm not in accounting.
National Insurance?
Yes.
Okay.
Corporate governance, that's interesting to me. Like I said, I'm not in accounting, but areas of interest was on the ad.
Okay.
Basically, trying to get a refresher.
Good, good, good. Okay, so this seminar course is divided up into two parts. There's the corporate governance part, which I do, and then there's the accounting, which Mr. Wilkinson does. So this first week is an introduction to the corporate governance part. Then Mr. Wilkinson takes over for like 3 weeks and does the detail of accounting so that you have an understanding of accounting. And then I come and wrap it up at the end. There is a test that Mr. Wilkinson does on the accounts. So he's the man to make sure you ask him what will be on the test. The corporate governance, we don't really test you too much on that. But the accounting is kind of technical, so they always require a test on that. Huh? I thought you was giving it to me. All right.
Thank you.
Okay, so corporate governance. Oh, for the new people, my name is Kevin Higgins. I spent 15 years at Central Bank of the Bahamas. I'm an economist by training. And then my last job was head of the Financial Services Commission in Turks and Caicos. I went down there and I worked for the British government for 7 years. I came home a couple of years ago. My wife was making noise that, lie down there and be up there, so I had to come in. Even though I was paying all the bills, but it's still. So I always had a job, and then I always taught part-time. So I used to teach for CLB or St. Benedict's University and all that kind of stuff, UWI. Because I always find that having one job where a person at the end of the year could say, I'm giving you a raise or I'm not giving you a raise, that's too much control over my pocketbook. I need to have two sources of income. So I always taught part-time. Okay, so corporate governance. Well, the first thing to understand is we always talk about management, and everybody has a pretty good idea of what managers do. But there's a group of people called the board of directors. And the question is, what is their role in a business, the board of directors? And corporate governance is about the role of the board of directors. And the reason it developed is because in the old days, people owned their own businesses and they ran the business. So they were the owner and the manager. But in modern companies, banks, insurance companies, manufacturing companies, what you have is you have the shareholders who are the owners, and then they hire full-time professional managers to run the business. So the managers and the owners are different groups of people. And as a result of that, you can have conflicts of interest. The simplest example is, for managers, the higher the salaries, the better off they are. But for the shareholders, for the owners, they don't want high salaries, they want high profits. They want to keep the salary and wages down because that's an expense for them. So because of this difference in point of view and perspective, you need to have a group appointed by the owners to oversee the management of the business. And that's the board of directors. Normally, once a year, there's an annual general meeting of all the shareholders. If you own shares in a business in the Bahamas, maybe you've attended a meeting. Once a year, they have a little report, the annual report, and they explain what they're doing, and then they have some drinks and hors d'oeuvres and stuff like that. But the idea is that is when the shareholders will elect who will represent them on the board of directors. And the board of directors is responsible to the owners, the shareholders, but their job is to oversee the managers of the business. They say that the best practice for boards of directors of financial institutions is that they should meet at least once a month. But definitely at least once a quarter, all boards should meet. They are responsible for making sure that the managers are doing their job properly. So that corporate governance is this oversight, I call it oversight, of the full-time managers of the business. So that's the first thing you have to understand. Now, in order to oversee the managers, directors have to understand the business. But it isn't just they have to understand the business. In order to understand the business, they have to understand the language of business. And the language of business is accounting. Again, I always tell the story that when I was in school, I hated accounting. Hello. But it doesn't matter whether you like it or don't like it. You need to have it if you're going to understand how businesses work. There is no way you can understand how a business is performing if you don't have a concept in your head of how a balance sheet works and how an income statement works. Because those are the reports that come to you telling you what the business is doing. And it has to do with capturing how much money is coming into the business, how much money is going out of the business. And those two, the income statement and the balance sheet, are the two most important financial statements. Now, there's a third one that Mr. Wilkinson likes to look at, and that is the cash flow statement. And the reason why he likes to look at that third one is because the income statement doesn't tell you the true cash position. There are things in the income statement that do not actually involve cash, so that the results of the income statement, again, this is why you have to understand accounting. That doesn't mean that if the income statement says the profit for 2017 was $1 million, that you can actually go and see $1 million in the till, because the cash position and the accounting position are different. So there is the income statement, the balance sheet, and then the cash flow statement is the third one that Mr. Wilkinson will probably go through for you. There are things in accounting which are tradition. There are things in accounting which are convention that they do because that's the rule, but you have to understand what the rule is and make the adjustment in your mind if you want to know the cash position. Okay. So, if you're going to be on the board of directors, you have to understand accounting. That's one very important part of your job in overseeing the performance of the business, reading, understanding the financial statements. The second side of the board of directors is compliance. Compliance has to do with making sure that the company is following the rules and regulations of that industry that the company is in. And for financial institutions, there is a whole host of rules and regulations. Betting, gaming, casinos, banks, insurance companies. I don't think there's any group of people who have more rules and regulations than these people. Maybe doctors and hospitals, I don't know. But once you're dealing with other people's money, there's gonna be rules and regulations. Not only there's rules and regulations, but there's people coming in from outside to check up on you, to make sure you're following the rules and regulations. And so part of the job of the board of directors is to make sure, first of all, that there's a compliance system in place for the company, and that the managers are enforcing the compliance system. So that's the second wing of the job of the board of directors, or the second pillar, I think I call it. And the third pillar is corporate strategy. What is strategy? Strategy is the long-term goals of the organization. What are the long-term goals of the organization? I had asked somebody from Fidelity to check their annual report so that they could tell us something about Fidelity's strategy. Who was going to do that? Did anybody look at the annual report? Nobody looked at it?
I skimmed it, but I didn't necessarily see
anything on strategy.
Yeah, it was more so just the audit report.
Just the audit report, yeah. A part of the role of the board of directors is strategy. Strategy is important because the world doesn't stay the same. The world changes. And a business that is going to be successful may be successful today, but the question is, will it be successful tomorrow if the world is changing? Again, a classic example. I remember years ago, on a Friday, I would pass by the video store and pick up some video cassette movies for the weekend. I had my VCR recorder, my TV, and I pick up some movies, I get one or two little daily ones, you know, for when the children go to sleep. And the wife sit up and hold hands, you know. That was how you spend the weekend. Get one pizza or whatever, and you watch these video cassette movies. You can't find a video cassette rental store anymore in Nassau. They were all over. They were all over the place. But the world changed. What happened? Cable Bahamas came along. Now you can get movies on cable. Not only that, you can get satellite dish with hundreds of channels. So why do you need to go and rent a cassette? Now, all
Watch them on your phone.
Netflix free.
there you go, Netflix. You know, you can do almost anything now actually on the phone, but I'm just saying, if you were a businessman, I remember there was a big video rental out west in the shopping center where Super Value is, because I live out west. You go out there, place shut down. What do you do as a businessman when your business is being attacked by changes in technology? What is your strategy going to be? Now,
That's correct.
huh?
You gotta change the
Change the strategy.
There are different ways to play the game. There are some people who said, okay, I'm going to take my money and buy shares in Cable Bahamas. There are some people who said, I'm going to get out of this entertainment business altogether and get into another kind of business. But you have to have a strategy to deal with it. Some people said, that's it, I'm shutting down, I'm not going to own my own business anymore, I'm going to retire. The strategy has to do with providing the guidance for the business to continue to be successful. Now, there are different perspectives. I know people in the Bahamas who every October used to go away, buy stuff, come back, rent space, and open a store just for Christmas. And then January they shut it down. So their strategy was short-term, Christmas. I know people who make baskets for Mother's Day, set up a stall on the side of the road, sell baskets, and then shut it down. But if you are a financial institution, if you are a company like an insurance company, a bank, you can't be opening and closing like that. Nobody can bring you no money like that. So you have to have a strategy to continue to survive. And the reason why I had asked about Fidelity, because you have the big Canadian banks who dominate the domestic market. And I was asking, what is it that keeps Fidelity going? Where do they get their business from? The young lady over here said they thief from Commonwealth Bank. They thief our customers. So I don't know if that's it. But anyhow, so I was interested in how does Fidelity see
right here.
yeah, how does Fidelity see their future? What are they going after? Now, Commonwealth, from it started, was always very clear on what they were going to do. They were into consumer lending. They lend for cars and furniture and vacations and so on. They weren't into no lending for business. They weren't into too much mortgages. And they have grown and been very successful by focusing on that strategy. So you have to have a strategy. You have to follow the strategy, but you have to be able to adjust the strategy when things change. Royal Bank is the oldest commercial bank in the islands. Royal Bank was here before Barclays Bank. Even though this was a British colony, Royal Bank came in before Barclays. Royal Bank dominated the market. They were the bankers to the government before the central bank. They handled all the government money. Right, they still have their accounts, but now you have central bank dealing with government registered stock and stuff on behalf of the government. But yet, Royal Bank is shutting branches. Now they're taking Finco and putting it inside the Royal Bank branches. So they are changing their strategy. Why? Obviously the environment has changed, and they are saying, for us to continue to make money, for us to survive, we have to adjust our strategy. The board of directors made that decision. That's their role. So you want people who sit on the board of directors who know the business, people who are able to oversee the performance of the business, people who are able to ensure that the compliance and rules and regulations of the business are being followed, and have a view of the future. People always talk about vision. Politicians like to talk about vision. Without vision, the people will perish. But if you have no vision, you'll go broke. You better have some vision about your business. Where is it going, or what do I have to do? Another classic one, I old, so I've seen so much come and go. I remember on the corner of Nassau Street, many years ago, Neil Ellis and his family opened a seafood takeaway business. And I forget the name of it, but it was right across from Dirty's. And it was a big thing, beautiful restaurant, signs and everything.
I remember that used to be Chicken and Never Did It.
At one time, yeah. But they had a seafood thing there. And they had advertising and balloons and grand opening and all kinds of things. I don't know if it lasted a year. It was a good idea, seafood, shrimps, and all that sort of thing. But for some reason, it did not catch on. Fast food, seafood doesn't seem to work in the Bahamas. If you go to the States, you have lobster, what do you call it, red lobster? And there's another one they have, another seafood pattern, Sister Silver, something, Long John Silver. They have fast food, seafood, or fast seafood, I don't know how you say it, in the States. But for some reason that don't seem to work in Nassau. But Dirty's, right on the corner, they got a strategy, they focus. They fry that chicken in that old oil, dirty oil, and they keep selling. My son, youngest son, he works in Boston now. He come back the other day, straight from the airport. He ain't even let me carry him home. Thank God he passed Dirty's and he gone to Bamboo Shop. He would embarrass me if he told me take him to Dirty's. But he gone to Bamboo Shop, right? He want chicken and crack conch and that kind of thing. There are certain companies that focus on a particular strategy and do it very, very well. So you have to have a strategy and you have to execute that strategy. And some companies do it well and some companies don't. But that is the responsibility of the board of directors. It's not for the general manager to be dealing with strategy. The general manager is making sure people come to work on time, you open the store on time, you have all of the inputs you need, your people get paid on time, the electricity bill is, that's the managers run the day-to-day operations. But somebody has to look at the big picture, and that's the board of directors. So this is what makes up corporate governance. This is what makes up corporate. Okay. So, the board of directors, let's focus on that. That group of people who are actually appointed or elected, however you want to say it, by the shareholders to represent them. There are two kinds of directors. There is one called an executive director, and there's one called a non-executive director. So the board is made up of two kinds of directors, executive director and a non-executive director. An executive director is somebody who works for the company, the business, on a full-time basis and sits on the board. somebody who works for the business on a full-time basis and also sits on the board. That's an executive director. A non-executive director is somebody who is appointed to the board but is not a full-time employee of the business. Okay? So if you hear somebody's a managing director, then they're probably a full-time CEO and they're sitting on the board. Managing director. But if you hear somebody's a general manager, they're probably just a manager. They don't sit on the board.
A managing director and managing partner, they're basically the same?
Okay.
Or?
We are talking about businesses, and we cannot just say business. So most businesses are incorporated. What does incorporated mean? It means they are formed under the company's law. And there are rules about setting up a company, and how many people must be on the board, and how many shares can be sold, and so on and so forth. So that's an incorporated entity. But there are some kinds of businesses that are formed as partnerships. The professionals like partnerships. So you will find accountants, lawyers, doctors. When they set up their businesses, they don't incorporate them in the old days. Now we are starting to see a little bit of it. But they make partnerships. But even with a partnership, if the business is doing well, somebody has to make sure that the light bill is paid. Somebody has to make sure the payroll is ready on Friday. So normally they will appoint one of the partners, that is the owners of the business, who will be responsible for the day-to-day management of the partnership. That's the managing partner. But they even go further. So for example, Graham Thompson next door, they have a lady who is a managing partner. I don't know how many partners they have, 10 or 12 or whatever. But they have a lady who is the managing partner. But then she has an office manager who reports to her, who she delegates a lot of the administrative work to. But yeah, a managing partner is the person responsible for managing, but they don't have a board of directors, they have a partnership agreement. So when they have their strategy meeting, it will be the partners who come together to say where the firm goes. And the rules for a partnership are different. For example, if I buy shares in Commonwealth Bank or in a business, and I sell my shares, that doesn't affect the business at all. I own them today, you own them tomorrow, you sell them to her, the business continues the same way. But in a partnership, every time a partnership leaves, a new partnership has to be formed. Every time a new partner joins, you start a new partnership. So it's different. So that's partnership. Okay, so we have the board and we have the executive and non-executive. Now, the non-executive directors are the most important because those are the ones who can oversee the executive directors. Remember that the executive directors are working full-time. They're the people who you're supposed to be checking on. They're the people who you're supposed to make sure are doing their jobs. So the non-executive directors are the most important elements within the board. Also, you want to make sure that of the non-executive directors, as many as possible are what they call independent directors. Independent directors. Independent directors means that they have no relationship with the company other than their directorship. They're not family, they're not friends, they're not retired managers, they're not former auditors, they're people who have no other connection to the business.
I don't know if necessarily happen in Nassau.
Oh, we can talk about Nassau. Nassau is a different set of problems.
The only thing I've heard so far is independent auditors.
Right.
Independent
That's
directors.
right, that's what I can talk about that. So, I used to work at the development bank many years ago, and I had to go to board meeting to present loan proposals. And the board would meet, and when you look around the table, there would always be one pastor who was appointed. And he would say the prayer to open the meeting, and then you wouldn't hear from him no more. Because he didn't know nothing about banking or loans or anything like that. Then you would have one, maybe lawyer, and he would want to talk about the legal aspect and the legal law and so on. Maybe he might know something about loans, if you're lucky. But he would be appointed because they say, well, he's a lawyer. A lawyer's supposed to be smart. So you have a lawyer. And then the rest of them would be political appointees, like generals in this constituency or whatever. And you would say to yourself, but these people are responsible for the development bank for millions of dollars. That is why right now at development bank, the arrears is like 40% of the loans are delinquent. You wouldn't see nobody on the board who worked for a bank before. I mean, the mind boggles. But it was like a way for politicians to pay back favors, because if you sit on the board, you would get per diem, you would get honorarium, you would get the Bank of the Bahamas, which was losing millions of dollars, was paying its directors $45,000 a year. They're losing money and you paying them $45,000. I'll do it for free. If that's what you want, if you want to lose money, I mean, I can do that for you for free. So we have some issues here in the Bahamas in that we haven't fully understood, and that's probably why today people are interested in corporate governance. We haven't fully understood the role of the board of directors and how important it is. People thought it was just, you know, you get together once a month, you have lunch, you sign some papers and collect a check. I told the group last Tuesday, when I was in Turks, I shut down a life insurance company. And when we went to have the final meeting with the board said they didn't realize things were so bad. And he said, but how you mean you didn't realize? Don't you get the financial statements?
What did you mean?
Or don't you understand the financial
when
statements?
you go to meetings, what are you discussing?
Yeah, I mean, what do you do? But the problem is, a lot of them were appointed to the board because they were part of a Methodist church group. Nothing to do with finance, nothing to do with insurance. And obviously they didn't read the reports, and if they did look at the reports, they didn't understand them. There's work involved in running a business successfully. It don't just happen, you know, by magic. You gotta, and you can't assume that the management knows everything. Sometimes the management might make a mistake, and it's for you to say, okay, but you said so and so here, but that doesn't follow here. So how are you gonna make the, you have to ask questions. And sometimes they need guidance. And you know how people hate to say, I don't know. But sometimes people don't know, they haven't had that experience before. So you have to provide guidance. National insurance. When I was in Turks, the British appointed me to the National Insurance Board there. So I sat on the board of directors for National Insurance in addition to my regular job. And there was a problem and they wanted to make a loan. But none of the people on the National Insurance Board had any banking experience. So they didn't know how to structure the loan. So I had to show them how to structure the loan. But you say, well, National Insurance is hundreds of millions of dollars. These people sit on the board, they're responsible. They don't have any banking experience. Okay, what kind of experience do they have? And then you say one is a taxi driver.
Oh, Jesus.
But that's politics.
No.
That's how it works.
Even with the British government that was like that?
Yeah, but they have local government that run the national insurance. They started the national health insurance, lost a lot of money because local government run it.
Just
And
like
then
us.
of course the British say we ain't getting you no money. You run it in the hole, you find the money.
So they had to shut it down.
I think last year it lost like $16 million. The national health insurance, not national insurance.
No.
National insurance makes
That's
money.
different, yeah.
Yeah, makes money.
National, because they pay even for doctors from the Bahamas, that's,
Yeah.
Bahamas to go over there.
The problem with the national insurance was in 2008 when they had the financial crisis and the stock market went down, they lost like 30-40 million in their investments.
Wow.
That was their problem.
That's obviously.
Because they invest abroad. Like here, National Insurance invests in the Bahamas. But because they have US dollars in Turks, they invest in the States and England and all over the place. So when the market, international market go down, they take a hit.
Big hit.
So again, you start to see how important is the board of directors and how important is the quality of the directors that you put on your board. You don't appoint people to the board just because they voted for you. You appoint people to the board because they know, they have knowledge, they have skills, they have experience, and because they're willing to say, I disagree with this. This is not correct. That's the kind of person you want on your board. Not somebody who just grin and say yes sir, yes sir, yes sir. So that's the corporate governance idea. All right. We have the board of directors, we have the non-executive, executive, and we say the independent. Now, the board can be anywhere from 3 or 4 persons up to 15, 20 persons. Normally when it gets too big, obviously it doesn't work very well. So the best practice is to keep it around 10 to 12 persons for most businesses, unless you're a super international conglomerate with stuff all over the world. You don't need 15, 20 directors. So you have your group of directors. Now, if the board is going to meet once a month or once a quarter, obviously you have to find a way to deal with all of the work efficiently. So the boards tend to operate with what are called subcommittees. The board of directors will pick 3 or 4 of its members and set up a subcommittee to deal with a specific topic. And then the subcommittee will report to the full board when the full board meets. So every board has subcommittees that specialize. And that is again why it's important to have non-executive, independent directors with expertise in different areas. So you'll say, well, okay, you're an accountant, an auditor, we're gonna put you on the audit subcommittee because you know about audit and accounting. You now are a lawyer, we're gonna put you on the compensation committee because you know about salaries and contracts and stuff like that. So you divide it up into the subcommittees. There are certain standard subcommittees that all businesses have. There are certain subcommittees that banking institutions have and trust institutions, different from, say, a manufacturing company or a cable Bahamas. So for example, all boards will have an audit subcommittee. Remember that the financial statements, The accounting tells the life of the business. So you have to make sure that those records are accurate. Records we're getting, the financial statement, are accurate. Part of the process is auditing. Let's talk about auditing for a little while. Where did you do yours, accounting?
Right here,
Right here?
right here.
So you finished the CPA? You did the exams already?
No, not finished the
Not yet?
ACCA.
Oh, you did the ACCA? That's the Canadian one?
That's the British one.
Ah, okay, ACCA. Okay, ACA is the Canadian, okay,
It's the
ACCA is the
Canadian
British one, okay.
Mhm.
Okay,
Not quite that.
okay. When a business is established, it has to keep accounting records so that it can track all of the funds coming into the business and all of the funds going out of the business. And that is the accounting function. Okay, today, of course, a lot of that is done on computer. Before, you used to have ledgers and manuals and all that kind of stuff. But now, a lot of it is inputting onto the computerized accounting system. So a business keeps accounting records. That's the first thing. But human beings make mistakes. Whether they're doing it manually or whether they're doing it on the system, mistakes will be made. You will look at a piece of paper, an invoice, and it says 101.10. And you look at it as $1,100 and something when it's $101.10. People make mistakes. So the first thing you need is what is called an internal audit function. The internal audit function are employees of the company who double check the accounting function. These are all part of the same business now. You have the accounting people, like the accounts receivable clerk, the accounts payable clerk, payroll clerk, all of those people who input into the accounting system. And then you have somebody who is the internal auditor who checks on their work to make sure that they're inputting correctly. Not only that, but they will check to make sure the reconciliation of what is on the system is correct with the bank account. So it's a double check on the information going into the accounting system. But accounts is so important that even that is not sufficient. At least once a year, they bring in the professional external auditors like Deloitte, KPMG, Ernst & Young to double check the double checker or triple check the double checker to make sure, and they do tests to make sure that the information is correct. But they don't just do tests to make sure that they can disagree. They can say this item here that you put in expense should be a bad debt and you should write it off. You can't hold that no more, take it off. You're giving an incorrect impression because that's no good no more. So they keep the accounting records as accurate and as possible. Now, obviously, there are going to be times where the managers of the business say, man, no man, that can make us look bad, man, no man. And so there's conflict between the external auditors and the managers, between the internal auditor and the managers. As a result of that, the board has a subcommittee called the audit subcommittee, to whom the auditors, internal auditor and external auditor, can speak directly. They don't have to go through the managers. They can go directly to the subcommittee of the board and say, this is what we found. This is what we think is wrong. So that the managers can't hide or block anything. So this committee, the audit subcommittee, is probably the most important subcommittee of the board. The big scandals in the States, Enron and WorldCom that shut down businesses and people lost jobs and so on, occurred because of problems in the accounting. problems with the external auditors. So that is an area that is very strictly watched. The Central Bank of the Bahamas has 2 external auditors. One side, the external auditor, they do the asset side of the balance sheet. Another firm does the liability side of the balance sheet. And when you look at the report for the central bank, they have 2 big firms sign on to say these are accurate. Now, I don't know why that is so. I don't know if they called them teeth 50 years ago or what, or if that's just, you know, to build a reputation or what, when they first started. But it's the only place I've seen in the world where you have these 2. You'll have Ernst & Young and Deloitte, or you have Deloitte and KPMG, but you always have 2.
Do they work independently of each other?
Yeah, because one
So
side
that means
does,
one side got to match up with the next side at some point.
yeah,
in time,
but,
the figures have to come back.
they will meet at the end and
Wouldn't know.
they will meet at the end,
Yeah.
okay? But they are responsible for the 2 separate
I
sides.
think they did that because most financial institutions, what they do is they have the same auditor year in and year out. So it becomes like a friendly situation.
Yeah.
And when they find things, it would go unreported.
We'll-
Right? It would be
we'll-
best to combat it that way.
We'll talk about
And
the
that's
law
why-
in the US.
And that's why some companies, they switch up their auditors.
Yeah, they try to switch
So,
them
like,
every year.
if like some places like Deloitte, if you have someone you even know, you have to let us know so that we could switch. So it could be independent. So
Okay.
don't be like, well, this is my best friend cousin, so I don't want to upset them.
Okay, let me tell you the true story now. The true story is in the old days, external auditors used to be hired because they were close to the managers of the businesses. That's how it started. And when they had the scandals in the States, 2001 or like that, with WorldCom and Enron, the Americans passed new laws. The most famous one is the Sarbanes-Oxley Act. And in the Sarbanes-Oxley Act, they made some strict rules that said, number 1, you have to rotate your external auditors. You cannot keep an external auditor for more than 5 years. Okay, because of the same problem of this lovey-dovey friendly stuff. You need to bring in a new external audit firm at least every 5 years. But even within the 5 years, you should rotate the audit partner who is doing the audit so that you don't have the same person signing off every year. So that's the first thing. The second thing they said is, if you have a firm that's doing your external audit, they can't do any other work for you. They can't be a consultant on computer or a consultant on this. You can't have them doing work where they're checking their own stuff. So that's when it became very, very strict. It's the Sarbanes-Oxley Act. But because of the scandal, and because it was so bad, I mean, this is, Enron was an energy firm that had billions, or supposedly had billions and billions of dollars. And people invested in them. And when they found out, it was broke, it was bankrupt, it was insolvent. It was so bad. So then they said that the senior manager, the CEO, have to sign off on the financial statements every year to say these are true and correct. Not just the external auditors have to sign. The managers have to sign. And they are personally liable if we find out later on that these figures are incorrect. Yeah. They're in jail. But then they went further. They say, if we find that these accounting figures are incorrect, you got to give back your bonuses. Well, then, you know, people start getting serious now. You got to give back my money? So it became very, very serious. So this whole audit accounting area that is why we're saying, if you want to know about being a director, if you want to know about how a business operates, if you want to have an understanding, you must understand accounting. You must appreciate what the financial statements are telling you. You don't have to be perfect. You don't have to be a CPA or ACCA, but at least you must have an idea so that when something don't look right, you'll ask a question. There's no point being on the board if you don't have an appreciation for accounting, because that is the story of the business, the performance of the business. There's a lot of people who think that, you know, law is a very good profession, and of course law is a good profession. But if you're going to run a business, you better have an understanding of accounting. So a lot of people now, you will find, are doing a law degree with an MBA, because in an MBA you get finance and accounting and so on. It's very, very difficult to be in charge of a business if you can't read the financial statement. It would be like trying to run your life without being able to read and write. Very, very important. Okay, so we have the board of directors, we have the first subcommittee, which is called the audit subcommittee. Now, another common subcommittee is the compensation subcommittee. The compensation subcommittee looks at salaries and wages, particularly the salaries for the senior managers, because obviously you don't want the managers setting their own salaries, okay? You want the board to decide how the managers should be compensated, not just in terms of salary, but also benefits and bonuses and all the other benefits that senior managers get. All of that has to be overseen by people who are independent. Otherwise, you have a conflict of interest. The other one is the compliance subcommittee. The compliance subcommittee. Again, this is 3 or 4 members of the board of directors who will be responsible for making sure that the institution has a proper compliance system that is being fully implemented and getting regular reports from the compliance officers. Because this is another one where you don't want the managers blocking the communication to the board. And that happens a lot, where the compliance officer will identify a problem and the manager say, man, leave that, man, don't worry about that. The biggest problem area is suspicious transactions reporting. There is a requirement under the law in the Bahamas that if you see something suspicious, you're supposed to fill out the form and report it to the money laundering reporting officer. And then the money laundering reporting officer will review it. And if they think it's suspicious, they're supposed to send it now to the
FIU.
Financial Intelligence Unit. But a lot of times managers will try to block the report going to the FIU, because of course the FIU will come in and investigate. So you get conflicts where the money laundering reporting officer says, I think I should report it, and the manager says, no, I don't want you to report it. And you could say, well, of course the money laundering reporting officer must do his or her job. But the reality is, at the end of the year, it's the same manager who's going to decide whether you get an increase or not. So there has to be in place a system where the compliance people can talk to the bigger bosses, which is the board of directors, if there is a conflict. So the compliance subcommittee is responsible for that area. Now, there are other kinds of committees that different kinds of businesses have. Sometimes you have an executive committee, which is supposed to provide guidance to the senior managers on day-to-day management of the business. an executive committee. These are all subcommittees of the board. Sometimes you have a risk management committee. Risk management committee. And then you'll find that banks have a credit committee, and they'll have an asset and liability committee. A credit committee and an asset and liability committee. I remember on the National Insurance Board in Choice, I was on the investment subcommittee and the procurement subcommittee. So you have different kinds of subcommittees depending on the type of business you're in and the particular needs of the business. And also, of course, the skills and expertise of the different board members. Okay, everybody get an idea of how the board functions and what the board's responsibilities are. Now, on the compliance side, I want to go a little bit deeper into that because that is, I think most people understand the audit thing, but the compliance thing is relatively new. And it really kind of went wild because of money laundering. And today, compliance is probably, one of the biggest functions in any financial institution. Everybody's a compliance officer. Everybody you meet, they're compliance officers. Big, big thing. So, when drug trafficking became a major issue for the Americans, and they started what they call the war on drugs, somebody decided, in addition to going after the boats and the planes that were bringing in the drugs, they should also go after the cash money that is generated by drug trafficking. I don't know if you ever saw the movie called Scarface. But in Scarface, you see them counting dollar bills. Well, not dollar bills, but $100 bills, I guess. And bringing in duffel bags to the bank to deposit. So it is a cash business. And they decided they would go after the cash. So the first law in the Bahamas that mentions money laundering defines money laundering as dealing with the proceeds of drug trafficking. That was money laundering, is if you helped a drug trafficker deal with the cash that was generated from drug trafficking, then you would be guilty of money laundering. Nowadays, we have developed further. Nowadays, in the Bahamas, we have what is called all crimes money laundering. So the proceeds of any criminal activity, not just drug trafficking, any criminal activity, if you deal with that, you are guilty of money laundering. As a result, every financial institution that deals in cash is frightened that they might take in money, and is found to be the results of criminal activity. So that's one development in the law. But another development in the law made this even more serious. Traditionally, only people could be charged with criminal offenses. companies couldn't be charged. And then the law started to change. Now remember that we are part of the English common law system. So it just changed the law. The law changed in the Bahamas because people in London, in the high courts in London, changed the law. And those laws affect us. So the first thing they said is, yes, a company can be guilty of a criminal offense if you can show that the mind and management of the company intended to commit an offense. See, the law is a funny thing. You have criminal law and you have civil law. And the example I like to use is, if I'm coming home from Iraqi drunk one night, and I see a fella crossing the road, and I say, you know, that's the guy who was talking to my wife. And I speed up, and I hit him with my car. Then you can say, I intended to kill that man. So you can charge me with murder. But if I'm coming from Iraqi and I'm drunk, and I see a man crossing the road, and I step, but because I'm drunk, I step on the accelerator instead of the brake, and I hit him. You can say that's manslaughter. I did kill him, but I didn't intend to kill him. Right. For you to commit a crime, you must intend to do it. That's the difference between an accident and a crime. In a crime, you intended to thief the money, not you made a mistake. Okay? I was counting, I count wrong. No. You intended to thief the money. That's how you go into Foxhill. Okay? Because you intended. So intent is the thing. But of course, intent means you must have thought it. So they say, well, if the board of directors, which is the mind and management of the company, intended to commit a crime, then the company is guilty of a crime. So now you're saying to me that the thinking of the board of directors is important, not only in terms of how they manage the company, but in terms of whether the company is guilty of a criminal offense. The law went further. The law said, okay, if a company says, we want persons who work for us to behave in a certain way, and people do not behave in the correct manner, not only is the company guilty of a crime, the directors are guilty of a crime. So people start saying, well, hold on now. The company is guilty, we pay a fine, no problem. But now you're telling me that because I'm a director, I am personally liable, I could go to Foxhill? Then they start to get very serious. So they said, well, how can we protect ourselves? I'm a director sitting in London or New York. I have a branch of a bank in Long Island. These Congo Joe people taking all kind of drugs up and down the place, and you come in to arrest me? They said, well, the only way you can protect yourself is to show that the board of directors has put in place a comprehensive compliance system to protect against money laundering. If you have put in place a comprehensive compliance system, then you can say, okay, the board has done its job. And it's that person in Long Island, the teller in Long Island, you must arrest. That's okay. But if you have not done your job as the board of directors and put in place a comprehensive compliance system, you are responsible. That's when it got serious. So today, when we talk about compliance, this is the highest priority for boards of directors, particularly financial institutions. If you are Cable Bahamas, I'm sure you're on the board, you're worrying about technology and all of that. I'm sure money laundering is not a major concern. But if you have a financial institution where you're taking in cash money and paying out cash money, that is the number one priority. After maybe making a profit, the next priority is money laundering. So what are the elements under our law that you must have to have a comprehensive compliance system. The first step is documentation, identification of the customer. Now I see the central bank is talking about changing some of these requirements because the central bank has guidelines, but you must know who you're doing business with. Right, know your customer, know your client. First thing is identification. Now, I don't have a problem with identification. Where I have a problem is when you duplicate. If I have my passport, why do I need my passport and my driver's license and my voter's card? And you know, that's where I have a problem. You have my passport, that's it. I went to carry, my wife was away, and they changed the system with the car plates, license plates. I carried my wife's car to get it licensed. They tell me I can't license it. I said, why? They said, well, you don't have your wife's passport. I said, what do you mean my wife? Well, I bring you her driver's license. This is a car. I bring you all the documentation on the car. What you need a passport for? The car don't go Miami. You need a passport for?
No relevant.
They tell me I'm being difficult. I said, I'm not being difficult. Just explain to me why you need the passport.
But you should never be in possession of somebody else's passport.
Right, so I said, so they say, no, you gotta wait till she come back and then she gotta come. That kind of stupidity to me makes no sense. So again, if I'm going to open a bank account in the States and I present my passport, that's it. Here, I go to people here, payments who know my father, my grandfather, my great-grandmother, and they're asking me, I need utility bill. I said, what do you mean?
They changed their ID card. I don't
What you
understand.
need
That used to
utility
say
bill
address.
for?
They give you a new one with no address.
Why do you, we have to verify? I said, well, first of all, you told me you have to verify my identification. Now you're going on to address. Identification and address is two different things. What you want to know? You want to come sleep by me so you see where I sleep?
The thing is that
And you could move at any point.
when
Transfer light.
the central bank had guidelines.
Yeah, I
and
know,
the
that's what I
banks-
said.
The banks took it to another level.
Yeah, I
This
said.
is not a necessity to have
Policy.
an
That's
address.
what they did.
Yeah, and they put it in their policy
Right.
to
Right.
make it mandatory.
Right, without thinking about it.
Mhm.
So anyhow, in my house, all the bills, water, electricity, cable are in my name.
So then your wife can't do nothing.
Well,
That she
I
need a
come in
letter.
now, I come in now.
Need a letter.
So I come to my wife, I say, sweetie, you know, you're gonna have problems with this banking requirements. So she said, well, why? I said, because when they ask you for your utility bill, you're not gonna have any utility bill. So why don't we put the electricity bill in your name? She said,
You jerky.
I thought I made second. I thought I get rid of at least one of these bills. I say, boy, I tell you, boy. Life ain't easy.
Yeah, you drop clean.
So anyway, the first thing is ID, right? And then you must, the financial institution has to hold identification documents for a specified period of time. And that time is up to, hold on, up to 5 years after you have severed, terminated the relationship with the client. Okay, that's the first thing. Now, I can explain how the seven came about. So that's the identification part. Okay, that's clear. The second part is you have to keep records of transactions. Different from the identification. All the ins and outs, money transfers, credit card charges, all those transactions, you have to keep records of those for the customer for 5 years as well. 5 years from the date of the transaction. So that was clear and was no problem. Then somebody came up and said, well, hold on now. We are all focusing on money laundering, but there's another concern. Under civil law, a customer can sue a bank for up to 7 years after the transaction. So you all are looking at money laundering, but really and truly, you need to keep your records for up to 7 years, because it isn't just the money laundering concern. You might get into a civil dispute with a customer, and you need to keep the records to be able to go to court. So the standard for the Bahamas is 7 years from the date of the transaction on transaction records, and 7 years from the termination of the relationship on ID. That's how we got this up, because of the civil law, what do you call it? There's a term for it. When you can't sue after you can't sue after the time.
I forget, there's a summer period.
Right, well, you know what I mean. Yeah, the time runs out,
Yes.
and you can't sue no more. Right.
Yes, statute of
Limitations, right, the 7 years statute of limitations. So you go to the 7 instead of sticking at the 5. That's how that's about. Now, the problem now that comes up is all of these records piling up. When can you get rid of them? So you got a whole new thing come up about now. They talk about records management. The Institute just had a big thing at the hotel. 2 days. Records management. When I was going to school, ain't nobody used to talk about records management. You finish with it, then you tear it up and you throw it outside. Nowadays, you need somebody who signs off to say, these records are outside the statutory limit, bam, 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 you can destroy them and so on. No backup is needed. Okay. The other thing that has come up from experience is that you also need to ensure that there is no ongoing investigation on those records. So suppose the 7 years has gone, but during that 7 years, you had sent in a report to the Financial Intelligence Unit. Before you destroy those records, you have to go back to the Financial Intelligence Unit and say, please confirm that there's no ongoing investigation so we can destroy these records. Because if you destroy the records, and then they come to you and say, but you sent us a suspicious transaction report, we are investigating the matter and you've destroyed evidence, then you're going to have another problem, even if the 7 years done gone. So records management is getting technical. So, ID transactions, okay. Now, there is also a requirement to report, not just record keeping, but reporting. The reporting is suspicious transaction. The law says every financial institution must have a system in place where they have a person who is responsible for receiving reports from the staff. That person is normally called the money laundering reporting officer, the compliance officer. Different institutions have different names. But if you are working with a customer or you're working with records and you see something, there is a form you're supposed to fill in, and there's a person you're supposed to, in your firm, who you're supposed to give it to. Then your responsibility is finished. Once you have made the report to the money laundering reporting officer, your responsibility is finished. But you must make that report. And my advice is always keep a copy. Because stuff disappears and people tell you, no, you never gave me. I don't remember it. So keep a copy. So that's number one. Then the money laundering reporting officer has a responsibility to determine whether to report it outside to the Financial Intelligence Unit. That's the tricky one. Okay, I know you all report to the gaming board, right? I mean, the betting and the casinos and web shop, they report their suspicious transaction to the gaming board and the police, or you're not sure?
No, they reported to the MLRO.
Right.
Who sends it to FIU? They do the same thing.
I don't think so. Check it. I think they report to the Commissioner of Police. maybe the FIU.
There's a compliance MLRO person.
Right, I know they have that within the company, but
They have to follow the same guidelines.
But I don't know if they go to just to the financial intelligence unit or they also go to, because I saw the first thing time I ever saw that they have to report to the police as well, the casinos and the gaming people. Theirs is different from the banks.
I think when the casinos, what happens is if like somebody wins a large jackpot, and you know when you're traveling back home, you have to declare.
Yeah, that's the American custom.
Some of the guests, they do not declare. That's
Right.
why the police is getting involved.
Right.
So,
But yeah, no, I understand that part, but I'm saying that there is, in the law for casinos, there's an additional reporting requirement. It mentions the Commissioner of Police. Check with your people and then next class you can let us know. But I remember that came up when they were designing the training for betting and gambling, that the reporting for suspicious is different than for the regular banks and stuff like that. Because of the involvement of the police. With the banks, we have tried to keep the banks and insurance companies away from the police, so they go just to the financial.
When you say reporting, you're
the
talking
suspicious
about
transaction report.
transaction or personnel.
The suspicious transaction report that the MLRO files with the banks and insurance companies and so on, they file it with the FIU. But with gaming and casinos, they have to file with the FIU and the police.
But for clarity, we have an enforcement unit that is stationed 24 hours a day. So
Who is we now?
the gaming board.
Right.
We have physical presence
So
of
they
the
report to
enforcement
you?
unit.
yes.
Right. So
Okay,
if
so
something
I know
happens-
it's something
because
different.
I kind of understand what you're saying.
I know it's something
If
you just
happens
don't
on
want
the
to make
table-
the use of the police. You just don't want to make the use of the police.
Yeah,
Use
so
the
if something
police.
happens on the tables,
Yeah.
they have to come to gaming
Yeah,
board. They
you're
can't
the
approach.
police. I
Yeah.
don't know why they don't put you in uniform so we don't get mixed up.
And then if it like that, we have an illegal gamble or something, we deal with it.
I
And
know
if push
that.
comes to shove,
Yeah,
the procedures they
So I mean,
carry chips
so
so I
back.
mean,
be
y'all
like
keep all
the
your
banks
stuff
and
to
it.
yourself first, and
Yeah.
then y'all decide if you're gonna make that.
No. What happens is they have a protocol. If an illegal gambler is to that table,
A crime.
a crime, the security, one of the bosses, the pit bosses in that area, they would have to call gaming or surveillance. Or surveillance would call
So
them
y'all
in
deal with the
turn.
crime yourself, and
We
then to
deal-
decide if you're going out to the police. Okay, I just trying to check
It all
that.
depends on that customer. It all
She
depends
tricky.
on the
What's
person.
that?
She tricky.
So you asking a series of questions. It all
Tricky.
depends on what's transpired between us and them.
Yeah.
Then they get escorted out there in cuffs, and
See?
everything was returned to the cage, and that's that.
I know there was something different. I remember there was something
Yeah, so
different.
it's the same thing. Identification.
Y'all wanna make sure
Everything you
y'all
have
get
to
that
produce.
money back before it reach the police, and the money don't get back.
No, but
Because if the money reach the police, that ain't coming back.
No.
If the police carry them, the money is a part.
No, that's the enforcement person.
No, the money is recorded
Yeah.
in front with the police,
I know.
the security and everything, but it would have to go for court purposes if that be the case, because immigration would now have to get involved as well, depending on the conversation that we have with them and the IDs that they produce, because we make them produce identification right there and then. We take them back to our office and they have to produce identification, and most times we find
The
persons
man
that are
owns-
working, they have work permits, so they try and tell it, they don't understand the law.
Yeah.
But you
All
can't.
the language.
You can't fully employ, yeah. But they understand quick.
The guy
They
who owns
understand how serious it is.
Majestic Toys, he got sent to court.
Sanders.
Yeah.
Just
He said he was lonely at home by himself, so he come over to gamble because he didn't have nothing else to do.
The son?
No, the
No, the
father.
father.
Say his wife died and he's by himself.
And all it will take is money and find
Yeah.
Yeah.
You know. But anyhow, okay, so there's the reporting. There's the record keeping, and then there's the reporting. And as I say, sometimes you can get conflicts between what the MLRO thinks and what the manager thinks. And we used to have a problem sometimes where you have a compliance officer who reports to a vice president in New York, but the manager here in Nassau is saying, I don't want you to filed that with the FIU, and the compliance officer in Nassau is saying, well, I don't report to you, I report to New York, so you can't tell me what to do. So we used to have those kind of problems when we first started. Now I think it's less because people are clearer on their risk and have a record of reporting it than for later on it to turn out that you should have reported it. And the change was made to the law to make the external auditors responsible for telling the central bank, telling the regulator, if they see during their audit any reports that were not filed. So now you have people checking up on you. You have the external auditors who come in once a year, and they will say, but you didn't report this. You were supposed, this is obviously suspicious. Not only that, but the central bank today does on-site examinations. So that is another part of regulation and supervision we never had in the past. Now the regulators come into your business and look at your files and your records, and if they see something that should have been reported, again, you have a problem. So it isn't just, well, we could hide it like that anymore. It's complicated. So record keeping, reporting. Now, what else is involved in this compliance system we're trying to develop? Well, one of the critical things is training. Unless you have, our law says once a year, unless you have training for your staff, you're in breach of the law. Compliance requires record keeping, yes, reporting, but you have to train people how to report, how to keep records, and so forth. So training is on several levels. There is the introductory training for new staff that everybody is supposed to go through. There is specialized training for the money laundering reporting officer or compliance officer. They need to obviously have a greater knowledge and expertise, since they're the ones that have to make the decision whether to send the report to the FIU. And there is updating, where you have new methodologies of money laundering that are developed to keep people aware of, because things change. The way they used to do it in the old days and the way they do money laundering today, those things are changing. So keep people aware of the new risks that are involved in their particular business. One of the new areas that people are concerned about right now are these money transfer people. I see an ad in the paper, Cash and Go is looking for a managing director. Omni, money transfer people. These are things that we never had in the past. So now you have to have specialized people looking at how. I saw these fellas come into Cash and Go, 3 fellas together, and each one of them wanted to transfer, I don't know, 1,000 US to the same person. So the lady said, well, hold on, the limit is 1,000. You want to transfer 1,000? You want to transfer? You want to the same person? No. So you know, there are different things that are happening that you have to be abreast of. So a compliance system involves all of those aspects, and part of the responsibility of the board of directors is to make sure that the company has a comprehensive compliance system. Now, of course, there are standard things like manuals, forms, etc., that obviously have to be in place as well. Otherwise, you can't say you have a proper system. So that's part of the responsibility on the compliance side of the board of directors. Now, all of this, we said, has become a big deal because directors are personally liable for these things. That means they can personally go to jail And there are 3 areas that we want to highlight that directors need to be aware of because they're personally liable. Money laundering is the big one, okay? Compliance, that is a big area, that is the priority area. But 2 other areas you should be aware of. One is insider trading. Insider trading. If a director takes advantage of his position, information that he has in the course of his business, and buys and sells shares in order to benefit, then, of course, you can be charged and you can go to jail. So that is conflict of interest type problem. And it's not just you personally, it's you and your family. When I was in Turks, the British don't fool around. You have to file every year a financial statement telling them how much money you have and how many children, houses, apartments, children under the age of a certain 18, I think, if they have bank accounts. All of this stuff you have to file. Well, I could do my part, but I didn't know nothing about what my wife had. Because my wife don't tell me nothing financial. The night before we got married, I was by my wife house, and I said, well, you know, this is how much money I make, this is how much money I save, and I'm paying on a lot here, and this is what I want to do. I said, how much you have? And she said, my mother tell me, never tell a man how much money I have. She didn't tell me nothing since then. So I just have to guess how many when I'm making my report. I just have to guess how much she has saved and how much she make and stuff like that. But you're required to disclose all of these things. Insider trading. The second one, or the third one, after money laundering and insider trading, is the prospectus. The prospectus is the document that companies issue when they're selling shares. If you are buying shares in a company, the company is required to give you an information booklet showing you the financial performance of the company, giving you all the information on what the money will be used for, all these kinds of things. And directors are liable for loss or damage caused by untrue statements in the prospectus. So if you have a prospectus that is misrepresenting the facts or basically lying, it isn't the company, it's the directors that are responsible for being personally liable for those incorrect, inaccurate statements. So there are 3 areas that, there are more of course, but there are 3 important areas directors must be aware of. Money laundering, insider trading, and prospectus. The representation or statements regarding the company's issue of new shares. Now, again, depending on the business you're in, there will be a law, an act. So you have the Banks and Trust Companies Act, you have the Insurance Act, and so on. And if you're going to be a director, clearly you should have a copy of the act that affects your particular business, because there will be other responsibilities for directors set out in the act for your particular sector. So you need to be aware of that. If you're in the credit union, on the board of a credit union, you need to be aware of the laws governing cooperatives so that you know what directors are responsible for, in addition to these general liabilities that we've talked about. Any questions? Okay. In your package, since most of you work for financial institutions, we have included the guidelines from the central bank for corporate governance for financial institutions. So that is something you should study, because that gives you an overall picture. Obviously, there are some changes currently being made by the central bank regarding documentation for money laundering, AML and so on. And obviously the gaming people, they will have a separate law act and regulations that they need to follow. But generally, Bahamas has had sufficient experience now so that we have pretty clear-cut guidelines that you can follow. And obviously, if you have questions or issues, you can contact your regulator for clarification. But when we first started, there was a lot of uncertainty. Now I think things have settled down and people are becoming a little bit clearer on what the rules and regulations are. Any other questions? No? Everybody's okay? All right. Like I say, next week, Mr. So Wilkinson will be here, right? And he will go through the accounting stuff, starting from the beginning, how the accounting process works. Firstly, double entry. We use, in this part of the world, we use a double entry accounting system. What that means is that every transaction, there have to be two entries. There has to be a debit and a credit. And he will explain how that works. That, of course, is part of the reason why we have a balance sheet with assets and liabilities, because everything has two sides to it. Double entry bookkeeping. And then he will explain how you keep track of all the transactions that a business goes through. First of all, you have a journal, and then after you've recorded them, how you divide them into subsidiary ledgers depending on the type of transaction. So for example, the purchase of supplies goes in one account, we call it T accounts. Then they have payroll accounts, etc. Then he'll talk about how you put them together to get a picture of the performance of the business. And like I said, he'll go through the income statement, the balance sheet, and the cash flow statement. You don't have to be an accountant, an auditor, anything like that, but you have to have an appreciation. And you need to learn the tricks of the trade in your particular business. So for example, if you have a bank and you look at the financial statements for a bank, you can see something called reserves. And reserves in a bank are assets that you keep on hand for a special occasion. So people build up reserves like savings in case something happens. But if you're in an insurance company, reserves are not an asset. Reserves are a liability. That is, reserves measure the potential claim you can get from outstanding policies. So you have to know the little trick. Even though the word is the same, you have to know the little tricks in your business. I always used to get confused where I say, okay, a loan. A loan is a liability, meaning I got to pay it back. But for a bank, a loan is an asset. That means I owe the bank money, right? And they could actually sell that loan to somebody else. So those are the little tricks. Then, as I was saying, you have non-cash transactions. The big one is depreciation. Again, I used to get so confused. What the hell is this depreciation? Depreciation is just an estimate that they put in place to say things don't last forever. So you try to put in place an estimate of how much wear and tear occurs on a piece of equipment or a vehicle, so that you can add that into your expenses. But you will end up getting, many times, an item that is an asset, something of value, like a computer or a car. Because of the rules say that over 5 years you have to depreciate it, on the books it'll be worth zero. But when you look at the computer, it's good. You could sell it for $1,000. So staff used to come to me and say, Mr. Higgins, you know the car that y'all have, we want to buy it. I said, well, how much you want to give me for it? They said, well, on the books it's only worth $100. I said, no, you can't get away with that. But you have to understand the bookkeeping is different from the reality, right? So that is what you learn from Mr. Wilkinson and his stuff. Again, one of the killers in banking is non-performing loans. When you have to start writing off money for non-performing loans. The idea is, and this is where the external auditors come in, you made a loan for $1,000. The person is supposed to pay you back $1,000 plus interest, but they have not paid you for 6 months. So the question is, do you really think you will get back that $1,000? Definitely you ain't gonna get the interest, but do you think you can get back the $1,000? That will depend on what kind of collateral you have, what kind of security you're holding that you could sell to recover those funds. So then you have to make a judgment about the collateral. And the external auditors might say, you say you can sell this property for $50,000 to pay off this loan. But everybody knows that in this area, you can't sell that for more than $16,000, $17,000. So you're gonna take a loss on this. You have to correct the accounting records to show the loss on that loan. And you have to deduct that loss from your revenue. So that's how the accountants try to keep track of how the money is moving, how the values are moving, and so on. Another example, used to give me lots and lots of headache. Loans in a bank is a big thing. But trust companies hold funds on behalf of clients. They don't show those funds on their balance sheet in their financial statement. Those are what they call off-balance sheet. And as a result of that, you never really know how much money is controlled by a trust company. Anything that's off-balance sheet gets tricky. You have to go into the notes in the financial statement to get a picture. So for example, a bank can say, we did not lend this gentleman any money, but they may have guaranteed a loan with somebody else. They may have given him a letter of credit. Those are what they call contingent liabilities. Means that it's not a liability now, but it could turn into a liability later on. So you have to keep track of off-balance sheet transactions, off-balance sheet items. Leasing. You buy a car, fine. You borrow the money from the bank, you buy the car, you know that you owe the bank money, and you have the car. If anything happens, you could sell the car and pay off the bank. What happens if you lease the car? You don't have a loan, all you have is a contract to drive this car. Can you put the car on your balance sheet and say that's mine? No. But is the lease a liability? Yeah, but is it a lease a liability for the 5 years or the 3 years? Or it's only a liability up to how long you use it? You're supposed to pay for the 5 years. So you have a liability but no asset. What sense that make? So these are the little tricky things with accounting. These are the tricky things with accounting. All kinds of things occur in accounting. Leases are tricky. Guarantees are tricky.
But after you pay off
Letters
the
of
car,
credit, huh?
after you pay off the car, then it's yours, so when it be,
You mean after you finish the lease? If you have a lease to buy, if your agreement says you lease and buy, but not all of them are lease and buy.
oh, if you,
Car and lease it again. You don't want that old car anymore. See, us rich people, we like to keep our cars up to date, you know what I mean? There are all kinds of things that occur in accounting you have to be careful. And like I say, you have to understand the transaction to make a judgment. Letters of credit. I used to be a manager of a bank in Nassau, and a gentleman came to me. He wanted to buy some satellites from a company in Washington State, but he had never dealt with them before, and he didn't know if they were good or bad. So he wanted to have something where he'll say, well, once I receive these things, I will pay you. So I said, well, you need a letter of credit. A letter of credit is one bank saying, from the buyer, saying to the seller's bank, okay, bank to bank, bank's talking now. My client wants to buy from your client. Once you send me the documents, I will pay you. But make sure my client's documents show that all of the goods have been shipped based on the agreement. Right? So, again, very tricky. But those are the kinds of things where you'll say to yourself, well, okay, I'm going to give him a letter of credit. It's not a loan, but it's a letter of credit. So I have to pay on his behalf once the documents come. So how do I get the money from him?
He doesn't have a savings.
Well, the question is, does he have the money, or do I have to give him a loan to pay the letter of credit? All of a sudden I got a letter of credit, and he don't have the money. I got to give him the money, because once a bank says to another bank, I will pay, they have to pay.
How profitable is it for he going to do?
I don't know, that's up to him.
Because I mean, if he had funds, you just get.
If he has cash, I
Hold
can,
it in escrow.
I hold the cash. I straight. Whenever the documents come, I pay, and I debit his account. But I got to make sure to do that before I make the commitment to the other bank to pay. I got to make sure I know where my money is coming from.
and why can't he go to his own bank?
No, I'm saying I'm his banker.
Oh,
I'm his banker. He lives here in Nassau. He's buying satellites from the States. And he's saying to me, I don't want to wire transfer them the money, because I'm not sure if I can get the stuff. I want you to talk to his bank to make sure you don't pay him till the stuff is shipped. That's how they do it.
So the clause in
The
there
big boys.
providing the product that comes, there's supposed to be a clause in that providing the product that comes. He takes full liability, because he could say you paid them and he got bad product.
Yeah, I got to make sure that it got nothing to do with whether he happy or not happy.
Right.
Once you get the documents, I take your money and I pay. Boom.
Right. The wording has to be right, the verbiage has to be right.
It's very serious. Very serious. And that is how you learn in finance. Accounting is so important. They have another thing. Somebody comes to me and says, Mr. Higgins, I need some financing. I'm expanding my business. I need some financing. And I said, well, what do you have I can hold as collateral? And he said, well, I don't know. I don't really have none. I got a bunch of people who owe me money. I said, well, what do you mean a bunch of people owe me? I said, well, all of these people I've done work for, I have billed them, and I have accounts receivable showing that they have to pay me within 30 days or 60 days. Now, in other countries, a bank can take those accounts receivable and buy them from that company. They call it factoring. So you can buy people's accounts receivable. Well, the accounts receivable are only worth if they're people who owe them are good people who are going to pay their debt on time.
I have the ability to pay.
Right, have the ability to pay, and if the records are correct, Because if he say, I did some work for this person and they owe me 10,000, but in fact, they have already paid 3,000 and they only owe 7,000, then you got a problem. So again, the accounting records are important. But finance, I always tell people, after God made woman, he stopped. Because the next thing, the sexiest thing in the world is money. You can do all kinds of things with money, but you have to understand it, and most people do not understand. People get into trouble with credit cards. Debt. They don't think credit cards are real debt. They just charge, they go shopping, it ain't real money until that bill comes at the end of the month. I remember I got a call from a bank when I was at the central bank. The lady say, Mr. Higgins, I see you paid off your loan. I said, yeah. She said, why don't you come borrow some more money? I said, for what? I don't need anything else. She said, well, why don't you just borrow the money and put it on fixed deposit? I said, you want me to pay you 16, 17% interest, put it on fixed deposit
For 7%.
3%?
Right.
She said, oh, I forget who I talking to. You have to be on top of these things.
But that's what they sell clients.
Yeah, you have to know what you're doing.
That's the
Money
same-
is a funny
That's
business.
basically the same thing with Fidelity's strategy right now.
What's that?
Their strategy is debt consolidation.
Man, you got all these fidelity there. The people
Fidelity
there,
is debt
they'll beat you, boy.
consolidation. And
But she just said she can find the strategy in the books.
Hold on, the debt consolidation, right? This that strategy now. They offer debt consolidation, right? But the fees, see that's the clause in there, because with Fidelity, let's say you qualify for $5,000, right? And you get a $5,000 loan. By the time they have finished adding their fees, you probably get $1,400 in your hand.
Well, you pay fees at every bank.
Yeah,
When
you pay fees
when
and
you get a
everybody, but your
loan.
application fee is outrageous.
It's
compared to
comparable.
other- No,
It's
Actually,
comparable.
the cheapest in
No,
all
it's
commercial
comparable.
banks.
never,
Thank you.
never.
But what that consolidation is you have, let's say you have 5 loans. So you're making 5 different payments coming out of your salary every month. What that consolidation is if your salary can accommodate,
Right.
we take all of that and put it into one payment.
Right.
To try to save you some
few
money
dollars
on
at
the
the
paycheck.
end, and what we
Right.
do is
And make
force
it
you
more
into
manageable.
savings. So we take some of that, let's say you're saving $400 in a month.
You know, I don't understand what John's saving. If you get a loan from your and John's saving, okay then. You pay him back $1,000, 500 grand of what savings and 500 grand of what your loan. You can't get nothing under savings till the loan is complete.
That's the point.
They're trying. Hold on, hold on.
That's the point of it.
They're trying. They're trying. No, Fidelity.
But that's the point of it.
Fidelity tries to depict. Fidelity tries to mimic.
But you paying interest in the
You get 5%. You get 5% on that. But the thing is, what we have to do, what we're trying to do, is get people out of the mentality of just borrowing.
Yeah, because they try
So
to
we have to incorporate the element of forcing you into the savings.
And as soon as they get that, they spend it anyway.
Right, so we could say to you, we'll consolidate and save you $500, and you get that $500, but you go and
All right,
spend it.
let me tell you some secrets now. My wife was working at a bank out west. So her salary used to go to a FinCo account, right? And a Royal Bank account. And then her savings went to a FinCo account. And every month she saved. Because it was downtown, she hardly went to the FinCo branch downtown. So the savings was building up nicely. So one day, she needed some money, so she gave me a book and asked me to go down to FinCo.
Lord, she give you that?
Get some money. When I see the kind of money this woman had on her account.
You didn't know yes no more.
But the problem with savings is you have to put it out of the way.
Right,
If
right.
you keep going back and sipping at it and touching it, you ain't gonna have no savings.
Right.
You gotta get it. So her thing was put it downtown because she's out working out west and she pay her bills by check and this money stays there and builds up. And that's the way to save. You cannot keep going back at it.
You have to.
You will have no savings.
You have to.
And the problem, I tell you, The problem is, most Bahamians do not have savings, and they're getting older. And one day, you see the FNM government, they're laying off people. One day you will be retired.
That's right.
You will not have a job.
And the pension is
pension money to make loans.
National insurance lady only will give you one
Well, you know national insurance. You have to tweak the letters to defend the national insurance because they don't allow you to pay no loan with your benefits.
No, but I'm saying, because you only get
you can send that letter on the slip, but I'm just sending money to the back.
So you better start saving now. That's the one side of
I
it.
had a pension.
The person in control of their pension, where they want their pension goes. So they decide to get one from you all fidelity or wherever, they just send the money to the bank.
Yeah, they can send the direct deposit.
No problem with that.
Yeah.
There's two secrets.
But they don't though. There's no requirement for someone to do that if you retire. There's
That's
no
what I'm saying, there's
requirement
no
for you
control,
to-
NIB don't control where your money goes. You basically say, but you wanna go.
No, it's your money. You are responsible. You're an adult. You know where it's supposed to go, where you want to go. But the two sides to this, secret to this, is to make sure you save on the one side and make sure you pay off all your loans on the other side. If you retire with no loans, no debt, you're in perfect shape. But if you 60 or 55 and you still get mortgage, my baby, you're in trouble.
You can't even retire.
You can't retire, you gotta keep working. You go into Walmart in the States, you got these old people saying, hello.
They never retire.
Can't stop working.
Got a toll and they great.
It make no
Bend
sense.
over.
You gotta be debt free and have money in the bank.
Yep.
Then you could laugh. Then you're in good shape. But you gotta start now.
But it don't end there, you know.
Well-
You have to also do money management, make sure you don't spend all your money before you die.
No, well, I mean, I ain't gonna live that long, so I,
My daughter had a
Saves money
survey to do
longer
for
than
school
time.
the other day.
That's what I say.
And persons were wondering, she had an assignment for school to do the other day. She had a little survey. And in that survey, they were asking basically the same questions about savings and money management and retirement.
right.
Not having to just depend on the government's pension,
Right.
but to have your own money
You gotta
set
have your
aside.
own.
So it came back unanimously that persons aren't living until retirement to start off with. So you had the vast majority of persons, they were like YOLO. They
not
spend
living.
while they living because especially males, they die before they reach the retirement to ever collect anything from NIB. So they're working all of their lives. And the pension will just sit there or however it's disseminated after the fact or go back to the
That's
treasury. because-
another thing.
So
too.
they just feel as if I don't need to be
If
saving
you ever
money
get
forever.
sick, if you get sick, that medical bill could pull your money down
Yeah.
fast.
Exactly.
I have a friend
names.
who worked over Paradise Island, and he told me, he said he had $700,000 in the bank. And he ended up having to get heart transplant and all that stuff.
One night that
One
was
survey,
gone.
one
Gone.
surgery.
So I'm saying, you
No,
know.
but he didn't have a major medical?
No, he had insurance while he was working, but when he got sick, he had to leave the
Yeah,
job,
and that's
the
another
premium stopped, and that's it.
And a lot of retired
You know?
persons finding that as well. When they sever and
Yeah.
they go, they have to now get, you can't get insurance at that age.
No. But some companies are not offering insurance as part of your employment
Oh,
package.
yeah.
That too, and those who like.
Yeah,
You have the vast majority of Canadians
I
who
think,
don't
I
have
think, I think,
insurance.
I think if somebody has worked for you for 10, 15, 20, 30 years, you should keep them under medical coverage for their retirement. That should be part of the retirement package. You know, I
Into
think
retirement.
the medical thing is a big expense a lot of times.
Yeah.
I used to cuss NIB, the small.
Used to?
Yeah, I stopped. The small amount of the monthly payment. But then if you get into the prescription plan that pays for some of your
Yeah, the
medication,
transportation.
then you start to see the benefit.
Appreciate it, yeah.
So I passed and I don't spit no more. on the side.
It's working for you.
I mean, my mom was sick and I had to go for medicine. I was like, thank God, then I be.
Yes,
Yeah.
diabetic pressure and pressure.
Diabetic pressure.
Those
Exactly.
on medications
I am telling you,
expensive.
that bill used to be almost $400.
Yes, and they only a month
And they
supply.
get the free working at the private pharmacy with them.
Yeah.
I say, boy.
Well, anyway,
Okay,
if you all know any young persons or persons that will be interested to do free financial coaching and fidelity, so they can come on down. We do free financial coaching.
That's right, child.
Just call them make an appointment. We're available on Saturdays as well, yes.
Let's sign up for that savings and that loan.
That's right, that's right.
I'm signing for the savings and not
Okay. It should be not true.
Okay,